Hello everybody, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation we are doing hypothetical computer simulated trades. They are believed to be as accurately represented as possible, but keep in mind that computer simulated trades can vary from live trades for many, many different reasons. If this is your first time with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, and myself and my team are here to help you win in the market and in life as well. Now, in a moment, we're going to be going over the winning trade. Before we do, let me tell you what I mean when we talk about an income or a high probability trading strategy. An income strategy is when we put ourselves in a position to make money from the passage of time rather than solely depending on price movement, meaning we can often make money whether the price goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does give us a much better chance than we would have otherwise. Now, when you find that you want more information as you follow along, simply contact us at lockeinyoursuccess.com. That's L-O-C-K-E in yoursuccess.com, or simply comment on the video below and we can get those questions answered for you. All right, let's move on. So the Super Bowl is a little bit different than most of the other strategies that we've been doing. It's less of an income strategy. It's more of a directional strategy. As per the name Super Bowl, it is going to be a bullish strategy. And it actually starts off what we call negative theta. And it does actually require that the price move up in order to make money. But that said, the wonderful thing about the strategy, as we're going to show you as we go along, is the probability of this making money is huge, and it has a history of very, very good returns. So this is a bullish vertical strategy that we can do on the SPX or the Russell 2000. We do it on the SPX primarily. It's going to require a minimum of between $1,000 to $1,200 in capital. Now, this is one of those trades that's like an all or nothing trade. So that being the case, it's going to have a profit target of up to 100%. It's going to rarely hit that number, but that would be the profit target. And that's going to be approximately $1,000 on the size trade that we're doing, which is going to be a one lot. And then we're going to have an exit loss trigger that's also 100%. So that being the case, the fact that you could lose your entire investment when you make this trade, you have to really position size it properly and position size it small according to your account. Now, on our example account that we use in our options trading for income webinars on Monday morning, we use 1/10 the account size. So if we're going to do a normal income trade that has a maximum loss of $1,000 in a $10,000 account, we're going to position size this trade at $1,000. Okay, hopefully that makes sense. So what I'm going to do is I'm going to quickly go over the guidelines of the Super Bowl, and then we'll show you its performance history over the last decade, as well as how it's been doing this year in this crazy, crazy market. So what we're going to do is when our monthly expiration cycle, our option cycle is 65 days to expiration, we're going to enter a bullish call vertical in a manner where the total potential profit and the total potential loss are about equal. Now, normally we go for $1,000 gain for $1,000 loss on a one lot. However, in certain environments, like this one here, when implied volatility skew is very, very flat and very, very strange, sometimes we can't get $1,000 credit. And in this environment here, we're closer to like $800 credit for a $1,200 risk. Still works out. We're still using the $1,000 planned capital, and that means we can have losses over what we would call 100%. But that's just the way we figure the numbers, so we can give you a consistent guideline as far as returns and stuff like that. So we're going to enter this one-to-one, we call it bullish vertical, and then we're going to do nothing until the next monthly cycle is 65 days to expiration, at which point we're going to take a look at the trade. So this is literally a trading strategy that you start and you don't look at it for at least 30 days. Okay, so we wait till our next cycle, 65 days to expiration, then we look at the trade. When we look at it, if that trade is up money, then we're going to exit the trade. If the trade's down money, we're going to sit in the trade and we're going to wait it out until that trade is profitable. And as soon as the trade is profitable, we're going to exit it at a profit. In the event that it does not become profitable and the market continues to go down, we're just going to simply exit it at whatever loss we happen to be at. Okay. At the same time, we're also going to enter our next trade, or trade two. So this is going to, a lot of times this will have overlapping trades. It'll have two trades going on at the same time. And like I said, we're figuring out profits on our planned capital for a single trade, but keeping it in context, we're registering our account profit and loss on 10 times that amount. So these are the historical statistics on the bull trade as well as the actual probabilities. So if we go from January 2011 expiration till current day, or currently closed trades, I should say. So currently closed trades, we've had 114 trades. For that time period, we've had a total trade for trade return of 1,970%. Of course, that's a small trade on a larger account. So if we divide that by 10, we'd be looking at like 197% over the time period. We're looking at a 86% win rate. We have a maximum consecutive wins in a row of 31. So yes, this trading strategy has won 31 times in a row historically. We have a maximum consecutive loss that we've had historically in that time period of 3. Keeping in mind our average loss is generally 2.7 times our average gain. So we do lose more than we win when we lose the strategy, but its win rate is so high that it easily overcomes that. But because we are trading with 100% maximum loss on the strategy, we want to make sure our trade size is no more than 1/10 of a trading account. We do that to maintain some sort of reasonable risk management within the account. So this is what we have here: fantastically performing strategy, and as you can see, it is high probability. There's even a lot of the other strategies that we look at here, like condors and broken wing butterflies and stuff like that. A lot of those don't even have an 86% win rate, despite the fact that the market actually has to go up or not go down in order for us to win. How has the Super Bowl done in 2020? Keeping in mind, right, this is a bullish strategy. It's a bullish strategy, and we had for 2020 one of the fastest, largest point moves to the downside than we've ever had in history. And we're still dealing with this volatile market in general. So this year, our January expiration was up 59.3%. Our February expiration was up 59.1%. Our March was up 51.1%. Our April was our losing cycle, and we're down 107%. Again, our planned capital is actually a little higher, or our actual capital is actually a little higher than our $1,000 in this type of environment. So we got a touch more than 100% loss here. And then May was a winning trade at 15.1%. And I can give you a peek at how June's doing also as we're going along, but that looks like that's probably going to be a substantial winner this month. So if you add those up, we have a total of 77.5% return. If you divide that by 10, which we'd have to do to adjust for an account size 10 times larger, we'd be up about 7.75% for the year in that account. And the wonderful thing is the market has been down like you wouldn't believe, right? So this is outperforming most people's long portfolio per se, for sure, this year. So let's take a look at the trade. All right, so here we are. It is March 11th, 2020. What we're going to do is going to come in here and we're going to sell a bullish vertical that's 20 points wide. And we're going to do it on the call side. We're going to do it on the call side so that if the market is down, we don't have to pay to exercise out of our options or anything like that, which is actually, with the new commission rates, it's not necessarily a problem with a lot of brokers right now. But at the time we developed this strategy, we would get charged if we expired options in the money. So we decided to do call options. If the market goes up, I'm going to close the position. I'm going to trade out of it anyway. If the market goes down, I don't want any execution costs on the way out. I just want to just take what I have for a loss and not worry about it. So This is going to be our entry, 20-point bullish vertical. Where exactly this is placed is going to depend on what's going to give us a 1-to-1 risk-reward ratio. In other words, what's going to give us $1,000 credit for $1,000 risk. In this environment, like I said, we can't get that. So even if I took this vertical and I did it up higher, like at 2790, even if I went up that high, I'm still not getting $1,000, and that's just a representation of the implied volatility environment. Sometimes I can actually do this back here and have my short strike at the money and get a 1-to-1. Again, it depends on implied volatility. But my point being, this is probably the best we can do in this environment. So the asset price is at 27.45. I buy a call option at 27.50. I sell a call option at 27.70. And this is what our entry position looks like. If we take a look at the price chart, we've gotten a really, really big down move, but we still have a lot to go if you remember the past here. So let's see how we're doing. So we're going to go just a couple of days here. Right, the following day we get one of the largest down point moves we've gotten in SPX history. The trade's drawn down $267, and it's looking pretty sad, right? Now, one of the things I love about this strategy is I'm planning on losing the whole amount. So I don't have to freak out if I get this horrendous market move to the downside. And I mean, the SPX can drop 1,000 points. I'm only going to take a normal loss. I mean, I don't like to lose, but I'm not taking like 2 or 3 times my maximum loss. Like a lot of trading strategies will use, they'll use, say, $50,000 trade size position, and they'll have what they call a maximum loss at $10,000. But there are cases in those types of trades where you get market moves like this, or market gaps overnight, or really huge implied volatility shifts, and you end up taking a lot more of a loss than you maybe expected, or a lot more than maximum loss. This here, my loss is predefined. I absolutely love that, and it allows me not to worry about the market going down like this. Now, realistically, when I'm trading this, I'm not even looking at this trade until my next cycle, which is June, is 65 days to expiration. So I'm not even going to look at this for another 34 days. I don't need to, but we're going to look at it just to show you what happened here. Right, so we'll just pop through a few days. You can see the market's all over the place. Right, so if I look at my price chart now, we entered, I think it was up in here somewhere, and we've had just an unbelievable downside move on the SPX. So here's what we look like. And I'm just going to advance now. I think this was the bottom of the market. I'm just going to advance ahead another week. Right, this is what we look like here. Let's advance ahead another week. So you can see the markets stayed down, but one of the good things about this trade is we're in it a long time. I mean, you can be up in this thing up to 65 days, and 65 days is 2 months. So a lot can happen in 2 months, as you can see. So let's pop this ahead maybe another. Actually, let's go to the 14th. So here we are, April 14th. We look at the price chart. We got this really, really big down move, which would have toasted most what we would call income trades, right? Because they generally don't like the rising implied volatility or these really, really big moves in the market. This wasn't a problem, right? Because we can't exceed our stop out point, so not an issue. We have time. So we let this thing come down, and now we start to get the market bounce. And as you know, from the previous moves we've been getting in 2016 and early 2018, late 2018, we get these huge down moves, but then we get these crazy V reversals to the upside. And this one is no different, right? So we come down, and now we got a big up move. We're now up $288 in the position. And this trade here is 66 days to expiration. Now think about trading this versus maybe some of the other trading strategies you may have seen, where you're having to make all these decisions, you have to make these emergency adjustments, you're always stressed out, right? No stress here. Basically, we weren't even supposed to even look at the trade until now, and as far as this looks like, nothing's even happened, right? So here we go to the following day. Let me ignore adjustments. We go to the following day, And yeah, we get a 62-point down move. We lost some of our profits, but our rules say our June is 65 days to expiration. We're profitable. We're going to exit. So we exit this at a small gain, $153 gain, but not bad for $1,000 risk. And from here, we're going to enter our June position. And let me see if I can take a look at that for you. And this is what we look like on our June position. We have the same thing. We're only getting a little more than $800 credit on this thing, and we're taking a bigger risk than we normally like to take, but that's due to the volatility skew. Moving this back and forth doesn't really help a whole lot, so I'll take the probability and get closer to the money. And if we run the June trade just for giggles here, and we come to the live markets, this is currently up about $358, and there's a good chance that it'll do fine. Our July cycle's coming in, so another 14 days. So we're going to be in this for another 14 days. And essentially, if the market is over, or the SPX is over 2805, this is probably going to be profitable. And the way the market's going, it may be very profitable by the time we close the trade. So that is the Super Bowl. It's a fantastic strategy. I guess I wouldn't completely classify it as an income strategy, but we can tell it is certainly high probability. And this is quickly becoming one of my favorite trading strategies. So that was this month's winning trade, the Super Bowl. If you like what you see here, I encourage you to come on over to lockinyoursuccess.com. That's LOCKE-in-your-success.com, and discover how you too can follow along with this and many other great strategies as they unfold during our weekly options trading for income webinars. Also, where you can learn about the upcoming winning trade presentations and explore past winning trades and receive access to free bonus material as well as our trading success blueprint. And perhaps best of all, you can get information on our free trading performance podcast, where you can learn to skyrocket your trading regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Please post that in the comments below, and we get those questions or comments answered for you. And we'd also encourage you to come over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of fantastic information on how to profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I can answer any questions you may have. Thank you, and I'll see you on the next winning trade.